Hope you're having a great day. I just wanted to showcase my dividend portfolio and the strategies that I use to build my portfolio. I have other stocks, but I wanted to explain why I choose to build a dividend portfolio and why I like the concept of being a dividend investor for the long run. If I go to the saved portfolios, I see the list of all the dummy portfolios I've created, but the dividend portfolio is a real one, and I've been tracking it for the past couple of months or so. And as you can see, we have started tracking this since October 27th of last year. And what's interesting is this portfolio has done much better than the market in the same time frame. We have a total return of 3.84%, which also includes the dividends that were paid over this time frame. And the amount I invested initially was around 31,000, and I picked around 30 plus stocks. I put in $1,000 in each of the stocks when I started, and the overall dividend yield for this portfolio at this moment is probably around 3.25%, or 3.18. And the list of companies in this portfolio is displayed in this heat map. For example, LMT, Lockheed Martin, the percentage change since I started investing is 20%. That's a really good return for the last couple of months or so. And it currently takes up 4% of my portfolio. So if you see, the lowest percentage allocation is for Mondelzo. It's a chocolate company, and it's around 2.5%. So try to split this weightage across all companies around the 3 to 4% range. And I do not plan to change the allocation in the future. I just want to let it grow as is. I'm not sure if you've heard about the coffee can approach. So as per the coffee can approach, the idea is not to keep reallocating every now and then. Instead, just let the portfolio do its thing. The winners will win and the losers will drop out. So for now, that's my strategy. And why did I pick all of these stocks? So let's say UnitedHealth, right? It has dropped quite a bit since I bought it. But the reason for buying UnitedHealth are multifold. And let's get into the stock page, and I'll walk you through why I bought UnitedHealth. And this kind of applies to most of the companies that I hold. UnitedHealth is currently trading at 331, so a P ratio of 17, so pretty decent. And they have a big market cap. And this is probably the largest health insurance company in the planet, not just the United States. So about UnitedHealth Group incorporates a diversified healthcare solution. They have Optum Health, Optum Insight, Optum RX, RX's Pharmacy. So they have millions of members. They also do Medicaid, Medicare, so on and so forth, which if you're in the US, you're already aware of. And the company's stock has underperformed recently. There was some negative news regarding the CEO at that time, and also some concerns with their growth potential for the future. So the stock dropped 60%. It has since recovered a little bit, but it's far away from its performance just in the last year. But still, I prefer to buy UNH because of the valuation. So we have a DCF valuation estimator here, discounted cash flow. I use discounted cash flow because I follow Warren Buffett and his teachings. That's how I learned most of what I know. I also have an MBA in Melbourne Business School, which is one of the top schools in Australia. And things I've learned so far has led me to believe, from a data perspective, that DCF is probably the best way to value a company, though we have a lot of other ways to do that, like a P ratio, which is very easy and straightforward, but there's a lot of scope to manipulate earnings. Price to earnings can be manipulated in multiple ways. It's very hard to manipulate cash flow. That's why I depend on cash flow. Okay, so what I see is a revenue growth of 7.7%. It's pretty decent in the last financial year that was audited. I'm using fiscal year financials not the quarterly financials, because the annual financials are audited by the SEC. So I believe those numbers are more accurate than the quarterly ones. And it would be fair to use that number to do the fair value estimation using discounted cash flow. And what I see when I look at this page is, for the next 5 years, Unit must grow at around just 1% with a terminal growth of just 1% to justify current market price at an 8% expected return. So if you are expecting 8% return, which is what I expect from the stock market personally, the company just has to grow at 1%. I think that's very, very reasonable. If I increase that target return to, let's say, 10% and apply the changes, now you see the fair value estimate is 250 instead of the 321 that you saw earlier, which is close to the current market price, which means I'll have to buy the stock at 250 to justify a 10% return, assuming they just grow by 1%. But let's say they grow by 5% or 8%, because they've done close to 8% recently. If you apply that logic, as you can see, it's 333, which is still close to the market price, which is around 331. Therefore, this company, in my opinion, is trading for a fair value. And I do show that the long-term debt information is unavailable in this case, and the fair value estimate could be inflated. So if you check the calculation for the DCF, in some cases the long-term debt is not included, and if you apply that, it might give you a lower fair value estimate. So it's up to you to decide if the debt is reasonable or not. In this case, they have 72 billion in debt. It's pretty high, but at the same time, they have a decent cash flow, and we can check that out in the operating cash flow here, which is around 24 billion. The free cash flow is also around 20 billion when I last checked in the financials. So in the financials, we capture historical information. At the same time, we have official annual SEC filing information. And going into that, I see in 2024 financial year, they had 24 billion in operating cash flow. But if I choose free cash flow, it was 20.7 billion. And the 2025 years data should be released soon. And I do expect it to be close to this data set. The revenue is growing at a decent clip, and they're close to 400 billion at this moment, which leads me to believe that they should be able to handle that growing debt also in the future. But the focus here is dividends. And if you look at the dividends, this company has been growing its dividends consistently over the past 10 years or so. And we also have a dividends page, which gives you information about the dividends being paid and also the dividend growth rate. So the 5-year CAGR is 12.5% and the 10-year CAGR is 16%, which is amazing. And coupled with the 2.64%, it's one of the best dividend-paying stocks out there. As long as they are able to continue growing their dividends, as a dividend investor, you're looking at a great return in the future just based on the dividends. Yes, in the recent year, which is 2025, they cut their dividends from the double digits in the past to just close to 7%, which is reflective of the challenges that the company is going through. But I'm just assuming that they would be able to grow this dividend at a decent clip as they had done in the past. Whenever a company is growing its dividends consistently, it means the management is interested in rewarding the shareholders consistently. Also, their dividend payout ratio is not too high. If you go back to the price chart, there is a ratio calculator for the dividends, and when I look at that number, it's close to 50%. So it's in a relatively safe zone, and they are not overpaying from their free cash flow. The dividends paid are still under control, which means they will be able to keep growing those dividends and not reach a certain cap. But again, the operating cash flow has shown some decrease. We'll have to wait and see how things pan out in the near future. So this is one of the reasons, or a bunch of reasons, that I use to assess a company from a dividend investor perspective. Is this a good company from a dividend growth perspective? Yes. There are a few checkboxes that I have to tick before I make the decision. As we saw, the dividend has been growing. The company's financials are strong. The stock price has been underperforming, which is probably good for us because we could buy more stocks of the same company. And I have chosen to reinvest the dividends, which means the dividends that I get out of UNH will be plowed back into the company's stock. And those dividends will buy stocks or portions of stocks within UNH, which will then generate dividends on its own. And when we continue to do this for several years, it will create a dividend snowball effect. You might have heard that term somewhere. So what is a dividend snowball effect? Actually, we have a calculator. It is a simple calculator to project, or we can use the advanced calculator. Maybe we'll use the advanced calculator. It'll take you to the portfolio builder page. And within this page, I can, UNH, I can add UNH. And since we just want to test this company, we'll leave it just to 100% and analyze the portfolio. We're not saving it now, we're just analyzing. So as you can see, if you had put $10,000 in this company in 1990, you would currently have $14 million. I'm not kidding, that's true. It would have been much higher if you look at the stock price a bit earlier. So the company is pretty solid. The maximum drawdown has been 72% during the financial crisis. I think it's probably here in 2008. The overall yearly drop was 52%. But their best year was 262% in 1991. So it's a bit skewed towards the IPO of this company. So to get a decent picture, let's change this. Let's say I do 2010 maybe, and analyze the portfolio from that date on. So since 2010, $10,000 has returned $131,000, which is more reasonable with a CAGR of 17%. The max drawdown was close to 60%, and the worst year was 2025, which is recent. That's last year, right? Interesting. But the dividend yield has increased just because last year the stock fell by more than a third, right? Now, talking about dividend growth. So we have this projected forward projections. So since I'm a long-term investor, I usually look at years 10 and forward. This is assuming a stock price growth of 6% and a dividend growth of 6%, which is reasonable as per market conditions. Because the market has generally returned around 6% over a long term for dividends, right? Now, if I don't contribute anything and I just keep reinvesting this dividend, after 10 years, the 10,000 that I put in initially should be around 23,000, but the dividends I receive is $557. Doesn't look like a lot, but then I also have a chart here, right? The chart shows you how the values keep changing year after year. There's also a table which will give you all the information for more clarity. But look at this yield on cost. When I started it was 2.64, but after 10 years it's 5.57. Now that's when the magic starts. The dividend snowball effect starts. And let's say I make it 20 years. I see the number has changed to 52,000 and dividends are more than doubled. And the chart is growing exponentially higher. And the yield has become 12.75, yield on cost, the initial cost that we put in. 30 years is a good time frame for retirees or even youngsters who want to start much earlier, like when they're in the 20s. And if you see the growth, the overall stock price now is 120,000 and the dividends have reached 3,000. That's the power of snowball effect. All we did was invest $10,000, and this company, after 30 years, is going to give you $2,900 and a capital return of $120,000, which is 12x, right? And we had very reasonable assumptions. If I don't reinvest the dividends, you only get half the money and you only get half the dividends. So that's the power of reinvesting dividends. It doesn't mean that you should always reinvest. As you can see, you still have a decent return. But for someone who's thinking long-term and retiring later in life, reinvesting dividends makes much more sense. And this is what I do for most stocks. I apply the strategy and see how they would perform in the future. So So if we go back to the saved portfolios that I showed earlier, and if I go back to dividend portfolio, it will show all the stocks that we have, which means I can clone this one and get back to this screen that I showed you earlier. And it's so powerful because it's doing everything on its own now. It's automatically recalculating for you based on all those stocks that we have in that portfolio. It's processing all the 31 stocks and it's giving me a consolidated return. It's starting from 2018 because it is limited by VC, which I have. It's a real estate REIT stock. But since 2018, this portfolio has almost doubled, 91% return, 8.5% CAGR, which is pretty decent. Maximum drawdown is 34%, and the worst rate is 5%, which was in 2018, of course. And the dividend yield is 3.18. Now, if we apply the same strategy that we saw earlier, over 10 years, my $31,000 portfolio should give me $2,299, and over 30 years, it's going to give me $13,000. That's like $1,000+ every month, and the overall portfolio value is almost $500,000 for the $31,000 that I invested, and that's my goal. I want to keep tracking it to $500,000 or even more if the stocks perform better or the dividend growth rate keeps going higher. I hope you will join me in this journey to keep tracking all these companies. I'll discuss United. I'll do a similar discussion for the other stocks. Thank you for joining. And please don't forget to like, share, and subscribe. If you have any questions, put them on the comment section. We'll have a good discussion. Thank you.